All right, ladies and gentlemen, I hope you're having a wonderful day. I don't have a watch list for you tonight. I'm a little bit under the weather, and there really wasn't that much action today. We did respond to the data very well like yesterday, and now everybody's talking is good news, bad news, good news, and that's really going to be the story for the rest of the week, and thankfully, we have big non-farms data on Friday, but now what I want to talk about today is how to short the stock market for free. Now, believe it or not, this is something that I did about 7 months ago on August 4th, and I just recently made the trade, but it is a free butterfly. So I want to go over this play right here. This is the one I'm talking about. It is for June, and it is a SPY put play, but like we brought up 7 months ago, the thing about this play is that it's free. If you go down here, you'll notice the trade price says 0, and this is a bearish play. So like I'm telling you, this is something we did 7 months ago, August 4th. I made this video, and we were saying 0 to 30K in 2 months. In this case, I did a lot more contracts than I did here, and this is really what I want to share with you is why I decided to go with it and what you should be looking for, because the fact that this trade is coming up 7 months down the line, I believe the market is like the exact same spot. So August 4th was like right here. Market went up and then eventually dropped. If you want to know how that old play culminated, it was a free play by the lows right here around 360. The day that it expired, I was up $10,000. I wanted to go for the 30,000, and then that very day, that was bad CPI. We actually had a monster rip, and it ended up expiring worthless. But the best part was it cost me nothing, and that's really what I want to talk about here and why I'm saying it's going to be important to look for moving forward, because the thing about this play is that it gives you downside protection. You can also do it to the upside, but the difference is there is no premium. So I already showed you that the trade price says 0, but why this is so important right now is simply every trade costs money, and a lot of insurance plays are very expensive right now. Most options, you buy a put or a call, you are paying a premium. Your max loss is whatever you pay for the options. In this case, the best part about it is that we cannot lose premium. However, where the risk comes from and what makes this play a little bit more difficult is that you have to put up cash up front. So before I talk about that, I'll just tell you one more thing. These butterflies, this type of option strategy, it is very low probability. If you go watch the video that I made on it the first time, and again, I would recommend that you go back and you could watch this because, one, we got to see how that play played out, but you could learn from it. I always give the disclaimer. I'm like, these are low probability plays, and even then, back in August, a lot of people were surprised that this play actually worked because it wasn't supposed to. But now, what makes it so low probability is that your max profit arises at your middle strike price. Pretty much by shorting the 360, I am saying by June, the market will go to 360. The risk now is that if anything goes outside of your options, so here we have a 354, if the market goes lower than 354, then you lose that initial capital that you put up front. So this is what I want you to notice about this play. One, go back to 7 months ago. Believe it or not, this is the exact same play. We're literally talking same exact strike prices. So 7 months ago, I bought it in August. It had 2 months of time. I grabbed a 360, or I grabbed a 365, shorted the 360s, and then bought the 354s. And the things with the butterfly, the middle contract, you want to sell double the amount of contracts. You'll notice these are two separate orders. This first one, we buy 50 here, buy 50 at the bottom, but then the middle contract where we expect the market is going to go, that is where we short double. So just make sure the ratios are the same. And again, none of this is a recommendation, but like I'm saying, back from 7 months ago, this is the exact same play, and where you lose money is if it goes lower than the furthest strike price, and then you give up the collateral. So in this case, to make this play, all I had to do was put up $1,000, and then in this scenario, the max gain off of, I think it's like, what, 10 or 20 contracts, the max gain is about $5,000, aka you make dollar for dollar from 365 to 360, and then everything else expires. So if you don't get how you make money with this play, the idea is you are buying a put. You could do it with a call as well. In this case, we're buying a 365, then we're shorting the 360 and then buying the 354 as insurance. That's what gives you a defined risk. Most butterflies, the gap between the distance is equal. In this case, I broke in the butterfly and made the back end. That's what made it $1 extra, so it's not fully covered, and that's why we have to put up collateral, but that's also why we got the trade for free. But how we make money in this play is that if the market goes to 365, imagine by June, the market is sitting at 360. That means these puts will be $5 in the money, so $500 per contract on 10 of them. And then as you see here, we shorted these 360s. This is worth about like, I think, I want to say $6,000 of premium so far. So if the market is at 360 on expiration day, these contracts will be worthless. So not only do you get dollar for dollar on 10 contracts, you also collect all the premium here, and then all of the money we spent here, which is about like $2,000, that would expire worthless, but then you walk away with the play of 360, 365 to 360. So that's the quick rundown. Again, I would go watch the past video, but like I said, the point about this right now and what makes this so important, I don't think it's a coincidence. You know, I want to keep my eyes out for these types of plays. I thought it was great how it worked out, but you'll notice it's almost the exact play as 7 months ago. If anything, I actually have one more month of time, and if you've noticed options lately, there's a lot of volatility. So by using an option strategy where we're both selling premium and buying and giving us a little bit more of upside, it works out very well, because if we could buy the right contract, the market moves down, and then you short the other contracts where volatility kind of kills them, that is where you get a very, very good benefit. So a lot of people were asking me about this play. Even if you go back to the original video, I think I give a better explanation, because we go over, like, I think it's like the profit calculator, and you could see the idea. Again, butterflies are very risky. I hope you guys have info. We have a lot of other videos on this on the channel. I hope you have info coming into it, because it's not something you want to force. And a lot of the big issues people make is, one, they get the ratios out of whack. In this case, you don't want to pay for these options. It's a broken leg option by making it where the strike prices are not equal, and I want it to be free, but the idea is I just don't want to spend premium. And in this case, you know, again, if it falls out of the range, that's the only way you lose. But if you make it kind of far enough, chances are that won't happen. But the big issue people have is either not getting the balance correctly, the ratio, or they end up spending money for it, spending too much, or they even do too little, and then they get a butterfly with a very, very tight range, and then it is hard to hit the price where you get max profit. So if I could give you anything, I would watch for these plays. I'd play with the chain a little bit. Again, in the last scenario, we had like 2 weeks of running up before it came down, and that play was still profitable. So I wouldn't be surprised over the next coming weeks if we see a couple more of these, or if you watch this play move around a little bit. But if you want to go shopping on your own, the number one thing you got to watch for, it's the middle contract. This is all you have to decide. If you think the market is going to go to 400, 420, 450, 300, 320, all you have to do is make a butterfly and make sure the middle body, that short, the middle contract that you go short on, just make sure that's the price where you think the market is going to go to, because that is simply where everything happens, and that is where you make max profit. So if you buy a put and you think it's going to go to 360, you short the 360, you make money on this one, these expire worthless, and then the insurance that makes it where you don't have to put up a ton of capital to get a play this big, that just expires worthless, and then you'll lose that money, but hopefully you made tenfold on the contracts that are way closer to the money. So hopefully this helps. Let me know what you guys think. I got another video for you guys tomorrow. We may either have a special or we'll get back to the watch list, but let me know your questions. Let me know if you did the butterfly. I know a lot of you did it 7 months ago, and let me know if we could follow up on this, or at the very least bring this on stream, youtube.com/thatstockmarket. We will see you there, baby. But I'm out. Peace out.